Welcome to Biotechonomics TV. Today we're going to talk about SPACs, Special Purpose Acquisition Companies. So what is a SPAC? A SPAC is basically publicly traded checking account. Now there's a lot of explanations out there on the web, and if you Google, they can explain the structure in detail. Well, basically what you're doing is a SPAC investor or a sponsor, as they're typically called, goes out and raises money from a group of hedge funds and other institutional investors. And that sponsor is usually someone who's reasonably well known in the investment community. They pool all the resources, they take this cash, and they go public. Now, once that entity is publicly trading, they're not going to be a publicly traded checking account forever. Within 2 years, typically, they either have to de-SPAC or acquire a company or just liquidate the SPAC and give the money back to the investors. That acquisition process allows that company to go public, meaning the SPAC is already publicly traded with a ticker symbol and everything else. The acquired company will come in and effectively take that company's existing listing, this existing SPAC listing. So it's basically going public through an acquisition because the company, as soon as the SPAC acquires it, it's now a publicly traded company because it's not going through a traditional IPO. So why do this? So this is becoming more of a trend across finance in general, but really in biotech, and there's a couple of reasons why. The main thing is that venture capitalists are getting really fed up with investment bankers underpricing IPOs. So a lot of venture capitalists, if you talk to them, they will talk your ears off about how they can't stand the existing IPO process because they're going out, the bankers are, and saying, okay, here, we're going to price this stock at $15 a share. Then, the same day, on the first day of trading, it pops to $20, $25 a share. So the VCs don't like it because their company that they've invested in isn't raising as much money as it could if it was trading what they believe is the true market rate. And the investment bankers are literally just taking a profit there. And so the VCs have been looking for a way to get around this. Also at the same time, hedge funds who are going to be buying these shares in a public market don't like that they've got to fight for an allocation within that pool of IPO shares, and they end up paying the higher price if they don't get that IPO allocation, and they're buying, later on the first day after the stock's already popped. So the way investors are getting around this in traditional tech is, and you see this with Spotify, it happened with Slack, it happened with Palantir, it happened with Asana, is using direct listings. Those companies I just mentioned all went public using direct listings, where there was no investment banker coming in, buying the shares, and then turning around and selling them out to a whole group of shareholders. Rather, they just basically picked up and sold their shares directly to the trading public, institution, retailers, and the like. So the problem with biotech is biotech companies aren't really good for direct listings. Those direct listing companies, if you're talking about Spotify, even Palantir at a $20 billion private market cap, they're well-known companies. They don't need a roadshow. They don't need a lot of hand-holding from investment bankers to go public anyway. So they're very well suited for direct listings. And you definitely see their venture investors, and the venture investors on the traditional tech side are pushing that more and more. Doesn't really work as well for a biotech, a smaller biotech, who's maybe looking to raise 150 million at a 500 to 1 billion valuation. It's going to be a lot harder, and they're going to need that handholding. So direct listings don't work as well. Enter the SPAC. If the biotech, instead of going through the traditional IPO process, hiring bankers, can instead go public by being acquired by a SPAC, which is already publicly traded, sitting there with a bunch of money sitting in the bank. They take that money, acquire the biotech, and now the biotech is publicly traded by virtue of its acquisition by the SPAC, which was already sitting on the exchange. So it allows the biotech company to get around the IPO process and not have to do a direct listing or build up a brand and everything else required to do a direct listing. Now, the other thing about this is that biotech, as I mentioned a couple episodes ago, biotech is the number one industry for US IPOs right now. 40% of non-financial IPOs are in the biotech industry, and that doesn't include non-biotech health. I'm not even including devices and other areas like that. So biotech is a huge potential market for SPACs, in addition to the fact that it serves biotech well. Hence, we are seeing a big increase in the number of biotechs going public through SPACs. So the amount of money that's being raised by SPACs has really increased a lot lately because of low interest rates and because of the investors looking to put money to work. So this is growing rapidly. But last year in 2019, just one biotech company out of about 50 that went public through a SPAC. So only 2%. This year so far, about 7 biotech companies out of about 70 that have gone public went public by being acquired by a SPAC, or about 10%. This year, there's been 15 investment groups that have gone public by creating SPACs, who are now obviously going to be out there looking for companies to buy. And they have said, in these cases, they're looking for biotech/life sciences. So I think there's a good chance next year we could see 20, maybe even 25% of all biotech IPOs going through the SPAC process as opposed to the traditional IPO process. This is going to really be a really interesting tool that's going to change components of biotech finance. You think about how biotechs fund themselves, whether it's through milestone payments and royalties and partnerships and venture and IPO. Well, SPACs are now going to be a really important tool in that financing set for biotech companies. And I think it could go up and down. There's obviously a lot of, if some of these investments in SPACs don't go as well, they might dim some of the interest a little bit. But I think this is a real trend. I think this is legitimate and something that's going to be worth paying attention to, especially over the next few years. So that's it for today. Please subscribe, and we will talk to you next time.